thank you for the incredible privilege of coming to share a few ideas with you. And my idea is very simple, is to remind us all, of things we already know that if we forget are extremely expensive, not only for ourselves, but most importantly for the clients we serve. So I'm going to start off with some headlines. The invasion ensues, war breaks out, sending the oil price up about 60%. Scary to think about. Inflation tops out at 13%, leading the Federal Reserve to increase interest rates cumulatively by more than we have seen in a generation. Everybody is thinking recession is just around the corner. When you hear these headlines, it would be absolutely reasonable to be thinking to oneself, big exposure to risk assets like equities should be something we should be running in the opposite direction of, and substantially cutting that exposure, running for the hills, putting money in cash or under the mattress. Except the headlines I've just given you are from 1980. The invasion in question was Iraq invading Iran. The oil price was $36 a barrel. The inflation number is the inflation number, and interest rates were about 4.5 to 5 times greater than nominal level of interest rates that we see today. The point of this little exercise is to say if you sat there then and you made the error of substantially cutting exposure to risk assets, it would have been a permanent cost to the ability to achieve the long-term savings objectives that clients in that day would have had. So what does that mean with respect to where we are today? So let's think about the headlines we are facing in actuality, how we're trying to navigate those headlines, and some of the important decisions we need to be making collectively. So let's start with some global headlines. And again, this stuff is stuff you read all the time, but I raise it to reinforce 2 or 3 important messages which I'll get to momentarily. So globally, what are the most important things we're thinking about or worrying about more accurately? Inflation and interest rates. Inflation is stubbornly high. The interest rate regime across the world is trying to defend against catastrophically sticky inflation outcomes, and the potential consequences of a policy error is recession. And we all know that recession is not kind to risk assets. That's number one. Number two, there is the tail risk that the war that we are seeing in Europe becomes not only a Russia-Ukraine war, but spreads and becomes much more of a global conflict. Now, we think the probability of that outcome is low, but it's certainly tail risk that could potentially have, catastrophic consequences. The third is I was going to call it the slowly brewing Cold War, but it's not slowly brewing anymore. The Cold War that is intensifying between the US and China. Ground zero of that Cold War is in the technology space, and if you think about how interwoven and intertwined the global technology space is, a complete unbundling that is not orderly in the way that it's executed could have very serious consequences. Right? To give you a few data points to think about 30% of US technology businesses have China as an end client, and about 20% of their manufacturing is in China. So a kind of sudden unbundling is not a realistic outcome, but you'd think that politicians simply don't read the room. So there's the tail risk that this thing is poorly managed and that the people who pay the price are people in this room and clients in this room and around the world. There's also the risk that China makes the mess of policy error by invading Taiwan. These are all tail risks, but it's things we read about, it's things we think about, and we're trying to figure out what do they mean with respect to how we construct portfolios. The final one, I would say, in the global stage, and there are many, but the final one that I'd like to share with you is we're clearly moving to a much more multipolar world. Now, if this thing is managed sensibly, which is unlikely, we could probably get through it. But there's a very real risk that it's not managed sensibly because the politicians are running the show. So let's bring that closer to home. You know, I think all of us, without exception, are intensely worried. You know, the headlines almost every day, without exception, you know, give us pause for thought around what do these things mean for our ability to create wealth for our clients, not because it's a fun outcome, but because it's absolutely essential if you're going to retire with any modicum of dignity. So what are the headlines that we're faced with? Same interest rate and inflation headline, right? You know, there's many who are arguing that the Reserve Bank is overzealous in its desire to protect inflation, and people are interpreting it as their desire to protect the rand, right? And the economy is already on its back. Substantially higher interest rates, you know, we can all agree, have very negative consequences. Safety and security, you know, we talk about it sometimes, you know, in laughing tones, but the fact that we worry about our safety and security at the individual personal level, at the organizational level, at the societal level, is very significant in the way we think about the courage to invest, the courage to stay. The other on that list is the energy crisis, the transportation crisis, a consequence of the failures at Eskom and the failures of Transnet. I mean, this list just keeps going and going. And the risk is not actually that all these risks materialize. The real risk we run is that we all make the collective mistake of thinking that we can time the market, and the right answer is to exit our client portfolios from risk assets. Because neither can we time the market, and we also know that real exposure in the long run to risk assets is the only way to deliver acceptable outcomes to our clients. So the way I try to think about this is that there are actually only two ways to navigate through this. The first way is to pick partners in the fund managers that you appoint to represent your clients who can construct resilient portfolios, trying to take this information and constructively think about what is the appropriate type of portfolio to build that is resilient against the unfortunate outcome or realization of any number of these risks. So to give you a few examples of some of the things that one would think about, it is clear that the world is scarier. It is clear that inflation is a problem, and so having an inflation hedge forming a significant part of the portfolio, like gold, right, is a very sensible thing to add to the portfolio, but not at 100% of the portfolio because we don't know what these outcomes will look like. But at some rational proportion, will provide some risk protection, some inflation protection in the portfolio. If you think about South Africa is a scary place, at least as we see it today, not commenting on whether or not it'll improve, but as we look at the risks on the horizon today, it's logical to have some proportion of assets allocated offshore. So many managers very logically have a very significant part of portfolios allocated offshore, and I think some of the smarter ones have reduced the US allocation because of valuation, but there's still some decent opportunities, you know, in Europe and Asia. But you can't completely ignore South Africa, because even if the bad news is true, even if we believe these things that we think will negatively influence portfolios, we have to think about, have they been priced in, and to what extent does the price reflect those risks, and therefore, from this point on, they represent an opportunity. To give you a few examples, if you look 5 years ago at the height of Ramaphoria, the rand was trading at just over 12 to the US dollar. If I pick a typical SA Inc. South African company, I'll pick Nedbank. It was trading on 12 times earnings. In other words, the price in relation to the earnings was at 12 times. It was delivering a 4% dividend yield, and it was trading at 1.8 times book. Fast forward the clock, the rand's just shy of 20, so a lot of the bad news you have to believe is priced in. Nedbank is now trading at 7 times earnings. It was trading at $300 in 5 years ago. It's trading at $200 today. It's trading at 7 times earnings and 8% dividend yield. Now, I'm not suggesting you should have 100% of your portfolio in South Africa, but you can't ignore the price. I tell this part of the story to demonstrate that The real answer is to have a partner who's going to construct a portfolio that's resilient and not try to time the exact impact, the exact timing of any of these risks eventually unfolding. And the other, which is a collective responsibility, is to help our customers, to help our clients navigate the risky proposition, or rather the scary proposition, of staying invested. Because when we're scared, the first thing we want to do is to run for safety, and the way we define safety in our minds in relation to our money, right, is nominal protection. Put it in the bank, put it in the mattress, and we all know that has very significant long-term consequences. So I'm going to end off with showing you a few pictures to remind us, everything I've said you already know, to remind us why it is important to kind of reinforce these lessons and how we can help our customers, help our clients kind of navigate, these sets of decisions. So the first one is, I'm going to use equities as the most important representation of a risk asset. So in the very short run, so what that picture tells you is the proportion of time or the number of occasions in an observation period that equities give you a negative return in nominal terms. So on your left, my right, you can see that's a one-day measurement. So how often do we see negative returns in equities over one day? Almost half the time. So it makes sense that if your investment horizon is one day, right, and you're completely scared, it makes sense to take your money out of equities. But that's certainly not the investment horizon that all of us have and that all of our common clients have. And you can see the precipitous decline the further out your investment horizon is. By the time you get to 3, 5, and 10 years, the risk of negative nominal returns from risk assets like equities is practically zero. Not completely zero, but it's practically zero. So fear in the short term poses the risk of having very long-term permanent, consequences. The other is the reason we have to fight that fear in the short term is because the real enemy is not the headlines. The real enemy is inflation. This is something we all already know, but sometimes when you see it reinforced, right, it gives us the courage, in the face of the fear. So what you see there is that what inflation will do to 10,000 rands of purchasing power today, looking forward. So I'm just going to pick one of those lines. If you assume inflation is on average 6% from this point, what destruction in your purchasing power is that likely to deliver? So let's use the 15-year mark. Let's assume someone is retiring at 60, and you give them a 15-year investment horizon. If you don't beat inflation, right? If you keep your money under the mattress, you lose half the purchasing power in that 15 years. Right? I mean, that is a very significant loss of purchasing power. The other thing we know for sure is that in the very long run, so not only is the risk of negative returns from equities in the long run very low, not only is inflation the most dangerous adversary we need to fight, we know that equities in the long run give us the greatest security of inflation-beating outcomes. Stuff, again, we all already know, but seeing it reinforced, I guess, is my objective here. These are Rand returns in real terms, in other words, after adjusting for inflation, from 1929 to 2022. And you can see global equities and SA equities was your most significant contributor to real return outcomes, that were available in the world. A balanced kind of proposition with cash, with equities and bonds. The next, gold gave you positive outcomes relative to inflation. Global bonds far less, SA bonds far less, cash substantially less, and that's not even taking out costs, right? So once you take off all the costs, all the frictional costs that are associated with having an underlying exposure, you can see the need to be quite far to the left in a long-run portfolio. But the next slide, which is my final slide, I think is my most important slide, right? And again, this is something we all already know, but seeing it reinforced, which is the desire to be smart, the desire to time the market, the desire to try to price in what are the consequences of these risks and how much am I going to be out of equities for how long. The cost of getting that wrong, the cost of getting those calls wrong, is represented in this chart. And I'm sure many of you have seen this before, which is if you take 100 Rand in 1995 and you put it in equities, right? The first long bar is if you just put it in and forgot about it, right? Your outcome is 3,000 Rand, which is not too dissimilar from this chart, this 7% real returns. So that 3,000 Rand, works out to about 13% in nominal terms. And if you think inflation was about 6% on average over that period, you can see the two numbers reconcile. But if you missed just 10 of the best days, the 10 days in the equity markets where markets were up, so the 10 best days, you went from 3,000 Rand to almost half. Now, I've been doing this for 25 years, right? And I've worked with some of the smartest investment minds ever. I can't even imagine one of them who could guess which of those 10 best days were going to be. If you miss 20 of those days, you go from 3,000 Rand to 1,000 Rand. And so it goes. The point I'm trying to make is inflation is the real enemy. Equities, risk assets, in other words, are your only way of making sure you're going to deliver a credible long-term outcome to your client. The risk of trying to be too cute in the short term has very permanent, very long-term consequences. So the things we've got to do, as a final statement, is partner with managers that are sensible in building resilient portfolios, and then together help our clients understand they've got to look through the noise and stay invested for the long run. So I might not have told you that life's going to be better next week, which was guys, let's call it command to me. That life is gloomy enough, my job is to make sure we all walk out of here kind of rah-rah. The reality is it doesn't matter what we think about tomorrow or next week or next month. The real job, if we take these principles, gives us the best chance of delivering the most sensible outcome to our clients. Thank you very much.